Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm your host, Michael Becker. Today I have one of my longtime friends, Al Silva, on with us. Al, appreciate you coming today.
Thanks for having me, Mike.
Yeah,
I appreciate it.
So Al is the Senior Managing Director of the Silva multifamily team for Marcus Millichap. Al's one of probably the only multifamily broker based in Fort Worth of the major groups here in town. Al's I like to call Al like Mr. Workforce Housing. He's really done a really good job of kind of branding himself in the workforce housing space. He sells a lot of that, as we'll talk about today. So Al, maybe a quick little background as we're kind of preparing. I took some notes. I believe you've been in the business since 2004.
That's right.
And came out of Texas A&M.
That's right.
And so your career, per the notes I took, you sold about $1.7 billion of multifamily assets in Texas, about over 30,000 units.
Right.
So maybe just talk a little bit about kind of your background, how to get in the business, and we'll go from there.
Sure. Yeah, no, I appreciate it, Mike.
Yeah.
Thanks again for having me. So graduated from Texas A&M back in December 2003. Was interviewing with different banking jobs, different commercial real estate brokerage firms, and interviewed with Marcus Millichap. Started there March 2nd, 2004. So it'll be 17 years coming up here very soon. Really fit into the culture of the company. Really started to build a book of business from the age of 22 years old.
Yeah.
It was a very different world, very different market. Back then, obviously, been pretty privileged to see all the big changes and all the big improvements that have happened, the market. And so, started out with just me, a one-man show.
Yep.
Over the years, I've grown into a relatively still small team. We like to focus specifically on workforce housing in Dallas-Fort Worth. Yep. So we don't really do a whole lot of Class A product. We really don't do a whole lot outside of DFW. Our singular focus is multifamily investment sales in Dallas-Fort Worth, so that's what my team focuses on. Yep. And so you've got myself, Ford Brawley, who's my partner. He's been with me 8 years. And then Brenna Lindsay is our marketing coordinator. And we've got some other back office staff, but it's a relatively small team, but that's how we like to keep it.
Ford's been there 8 years. Doesn't seem that long for him either. I guess they're getting old now. So maybe talk a little bit kind of the growth of your business. You've done about we said over 30,000 units, 1.7 billion in sales. What did that look like? Kind of maybe 2005, I think was your first full year. What did that look like there? And then kind of maybe as we're in 2021 now, maybe 2019 or 2020. What kind of like volume did you do in those various years? Kind of show the growth of it.
Sure. Yeah. I mean, in 2005, I'm just cutting my teeth in the business and ended up doing about 5 deals in 2005, total about $15 million. So that grew though. If you go up to, 2017, we did 33 deals in 2017, over 350 million in volume. 2019, we did 20 deals totaling 3,000 units and 235 million in volume. 2020, you go into that year thinking, hey, we're going to continue to grow. We're going to continue to get better. And then obviously the big curveball hit. But we still ended up only with about a 10% drop in dollar volume. We still did 15 million in volume, still did 2,800 units, 16 deals.
So you're going from probably starting out somewhere in the 20,000 a unit average door price. And then recently your probably average door price of the real workforce housing stuff is probably what, 80, 90,000 a unit?
Right. Yeah. If you go back to 2013, we did 10 deals, 1,500 units, about $50 million in sales volume.
Yeah.
That's about 35,000 a door average sales price in 2013, which that was a great year back then.
Sure.
But you go back to last year, 215 million over 2,800 units. That's about 87,000 a door, just to show you the growth and valuation that we've seen.
So let me ask you a question. Are you interested in investing in high-quality multifamily properties with a proven and experienced operator? Michael Becker and his team at SPI Advisory have successfully purchased, repositioned, and sold thousands of apartment units with substantial profits over the years. If you would like to get notified when investment opportunities open up, please go to www.multifamilyinvestingshow.com and fill out the contact form. You will be notified when SPI Advisory has a new investment opportunity.
What's really changed in Dallas-Fort Worth? I mean, the first deals you did probably were signing some contracts to the back of a pickup truck or something.
Right. I've done that actually.
I'm sure you have. A lot of local guys, and then what's kind of changed in that 17 years now that you've been in the business.
So many things have changed. Everything from the level of sophistication of the average owner. It was very much a mom and pop ownership base in the workforce housing space back when I got started. There was a lot of back of the napkin P&Ls. There was a lot of just mom and pop accounting software, having to go through and figure out what the numbers really were. That took a lot of time and resources. So the ownership base has changed. It's become a lot more sophisticated. The transparency in the business has become much greater. When I say transparency, I mean access to information. So whereas before you had to go kind of beat the street to figure out what rents were, you had to, it was everybody's secret what cap rates actually were. Were the numbers you were looking at real, or were they, contrived? Nobody really knew at the time. It was a lot harder to ascertain what was real and not. What's happened over time is not only have the investor base become more sophisticated, but also you've got all these information services now. And so you can access all this information about transaction data, about rents, about cap rates. And so you can kind of paint or put that picture together for outside investors and make them a lot more comfortable going in and buying property. I'll give you an example. One of the earlier properties in my career that we sold, it was called Mayan Palms. It's a 208 unit deal over in East Dallas. We sold that in 2006 for $17,000 a door.
Wow.
A 9.7% cap rate, if you could believe that. The interest rate on the debt was 6.5% at the time. And that was an attractive loan in 2006.
And it was amortizing too. There was no interest only.
There was no interest only. There was no CapEx that was levered into the loan.
Did anyone that at that time, was anyone doing the value add? I mean, that market was slow and rents weren't growing.
Right. No, they really weren't. And it wasn't because people didn't get that was a possibility or didn't understand it. It's that the numbers didn't work. Back then you go into certain submarkets, your average rents for a one bedroom were $400. It was really hard at the time to make money owning workforce housing. You could own B and better type product, and you still had rents that could justify making improvements. But as far as the workforce housing, you couldn't really justify it in the numbers. And so, for example, Mayan Palms, the deal I just referenced, we sold it in 2006. Their average rents were $565, 17 a door, 9.75 cap. We sold it for the same owner in 2012. For $21,000 a door. The rents had only gone up $10 effectively, but the cap rate had compressed from a 9.75 to about an 8. And so what started before the rents started really increasing was the cap rates did compress, and the reason was we were coming out of the Great Recession. Back then, workforce housing, a lot of those folks were buying houses. It wasn't until after the Great Recession that drove the American way of life for blue collar folks into renting, and you're not coming up with 20% down payment. You don't have the credit history. And so that really solidified workforce housing. And so what you saw as a result of the workforce housing becoming a renter group of people is rents started going up quite a bit. We looked at that same deal again last year just for fun. Their average rents aren't $575 anymore. They're $875.
Wow.
The property is not worth $21 a door. It's worth $80 a door now. And obviously interest rates are much, much lower. So the cap rate's going to be kind of in the low fives at that price. And so that just shows you an iteration of how much has changed, just kind of in the story of one property in East Dallas.
And another good example I think might be, you actually sold a 2-property portfolio for me. We bought that property, was Wedgwood, and we changed the name to the other one to Bills del Sol. I think we bought it in 2014 for $29,000 a unit, and then you sold it for us in 16 or
2016.
2016. We owned it 2 years, and I don't remember what you sold it for.
We sold it for $55 a door.
55
in 2016. So that was a home run.
Yeah,
that was a home run, right?
We had a mortgage on it, so we were dumb in the early part of our career. Put a lot of 10-year Fannie Mae money on it. So they assumed our mortgage for $55 a door.
Right.
You sold that again a year or two ago?
Yeah, it was just January of last year, almost a year ago to the day. We sold it for $87 a door. The cap rate was lower. And the folks who bought it from you, they're good owners and they took good care of the property, but they didn't really go in and do a big value add program. They didn't do a big heavy lift to the property, but they still managed to grow the NOI in less than 4 years by 41%.
It's amazing.
And so that's really the dynamic. You look at Mayan Palms, you look at Villas del Sol and Wedgwood. That's the story of our market, is because of all the population growth, economic growth, all the transparency that's come into the market. You've had cap rates drop significantly, while at the same time NOIs are going up significantly. And so those are both two perfect examples of what's happened.
And then speaking of like our current environment right now, what's the demand level? I just had Ken McElroy on our last episode, MC Companies, and he was talking the deal story. I listened to him interview and talk about the Fielder Glen deal that you guys just had, and he was in the mix. And I don't know what price he came in, but he made the best and final, and he was talking about how there was like something like 25 bidders. So maybe talk about the current state of the buyer pool, and maybe use that as a good example of kind of what's going on right now in Dallas-Fort Worth.
Yeah, sure. And so I think Fielder's Glen is a really good kind of case study for the dynamics of the market in the second half of 2020. We went into 2020 thinking we were going to have a record year for rent growth and for job growth and population growth, transaction volume, record low interest rates. You had record low unemployment across the board. So it was really looking like a home run year in the making. We had a record Q1 last year for our team in terms of sales, and we were expecting the whole year to be that way. But obviously when the pandemic hit, everything just completely hit pause or stop or rewind even for 3 or 4 months, as you know. And so it took time to really everybody to gain their footing back and realize that economic vacancy wasn't going to 40% and that rents weren't going to drop in Dallas-Fort Worth. They did drop in some other markets, but we were seen as a relatively safe market to invest into. And so what happened is, as the capital markets kind of unfroze in kind of that mid to late summer period, we started to see a lot of what we call a snapback effect. Things started to really come back. And so we played a lot of catch up in the second half of the year. So Fielder's Glen is a great example of that kind of effect. It was a 220 unit Class B property located in Arlington. We had 45 property tours in a 3-week marketing period.
In 3 weeks, wow.
3 weeks. The owner had an off-market offer on the table at $23.5 million that he was about to take. And I said, Mr. Seller, don't take it. We'll go get you more. I guarantee it. And so our guidance was 24.5. It was $1 million more than his best off-market offer. We ended up with 38 offers.
Wow.
I call it the deepest and broadest buyer pool that I've seen in my 17 years in the business. We had everybody from large and small private equity groups. We had local syndicators, local investment club groups, international investors. So I call it the broadest and deepest pool of buyers that I've ever seen in our market. And there was a shortage of deals on the market for sale. That's one component of it. The other component is it was untouched. It was 18 years under the same owner. You could go in there and with a blank canvas in a B+ submarket and really move the needle on rents. And that's an exciting story in today's world.
Yeah, that's amazing.
And so we ended up selling for over 26.5 is what I can tell you. So over $3 million more than the best off-market offer that was on the table, over $2 million more than our initial price guidance, and we had $1 million hard day one. So it's just remarkable the amount of activity.
That's pretty. That's a really good encapsulation of what I'm kind of seeing in the marketplace. You're seeing a lot of these guys. These deals that you sold went from the 9+ cap range, and now I don't even know what the cap rate is. Probably can't even calculate the cap rate on a deal like that. But generally speaking, kind of that high 4s, low 5s, and the true workforce housing and workforce locations, and that's kind of what's going on. And you're seeing a lot of these groups that have, like myself, that owned a bunch of workforce housing. We traded out and started trading up in quality of vintage as well as location. So we're getting the stuff that's maybe 10 or 20 years old, selling the stuff that's 50 years old and buying stuff that's 10 years old, and basically doing it for the same cap rate, which has been a really, really good trade. And I think we're seeing more and more of our marketplace maybe kind of take advantage of that. Maybe that's some of the people that are listing with you right now.
Yeah, no, and that's what we're seeing as well. I'll give you a really good example. There's a property called The Colony that we were marketing right as the pandemic was kind of getting started. We had just called for offers, just awarded the deal out. We had sold that property in 2013 to the previous owner for $7.75 million. It was about a 7.5 cap deal, about 43 a door. Okay.
This
at
is
the time.
70s vintage in
Yeah.
Irving, Texas.
Yeah,
So really,
1968 vintage deal in North Irving.
Yeah.
Really great location. A lot of great dynamics. But it was an older property. It
Yeah.
had a chiller system. It was master metered. But he had bought this for $43,000 a door, which at the
Yeah.
time he said, "Oh, Al, I'm overpaying. I can't
Yeah.
believe it." And we sold it last year for over $113,000 a door.
wow.
A 5.1% cap rate. And so what we did with all the capital gains, $13 million in capital gains on
Yeah.
one asset in 7 years is pretty remarkable. But we took those funds and plugged them into a 2000 vintage property in Grand Prairie, 192 unit deal called the Destino with 9-foot ceilings in just as strong of a location.
Yeah.
But we plugged him into Destino at about a 5% cap rate.
Yeah.
So I think, right now people ask, well, where's the opportunity in today's market? Everything's so expensive. How are we going to create value in today's environment? And what I tell people is in my entire 17 years in the business, I think this Colony to Destino kind of deal story
Sure.
is just an encapsulation of what the opportunity is in today's market. You can sell older properties that maybe aren't in as good of a location, and you can buy newer assets. You can buy assets that are better located for virtually the same cap rate. That spread has completely almost gone away in this world. And so, and that goes for going from tertiary, secondary markets to primary markets. There is arbitrage out there if you look for it.
So you're looking at in Texas like a Tyler or a Sherman or a Waco or some market like that. That's mid to small kind of secondary, tertiary market. Those cap rates there are basically on top of Dallas Fort Worth right now today. Is that as well, or the spread certainly compressed quite a bit too?
They're going to be a little bit higher in those markets. The cap rates are, but the spread has shrunk to a point where I don't think that the risk premium that you're getting is sufficient to compensate you for leaving such a diverse economy like DFW and going into a place that might depend on just a couple of industries.
Yeah, that makes a lot of sense to me. Now, when we talk about Dallas Fort Worth, most people focus on the Dallas side, and you're a resident of, and your office is based in Fort Worth, and you're the only major brokerage shop in town that has a headquarters in Fort Worth.
That's right.
So I think you have a pretty unique perspective of it. What if I'm coming in from the outside and I want to understand the two sides of the marketplace? What's your kind of basic take on why should I pay attention to Fort Worth over Dallas, and what are some of the drivers and the good things going on over on the west part of the metropolitan area?
There are a lot of great things happening over there, as you know. And I was born and raised in Fort Worth, and so I've seen it grow not only during my professional career but my entire life. We had about 300,000 people living in Fort Worth when I was born in '81. What people don't know about Fort Worth, back then it was more of a blue collar, more of a sleepy, almost considered a suburb of Dallas, which you'll never hear anybody in Fort Worth admit that, but that's pretty much what it was at the time, dependent on just a handful of industries, a lot of oil and gas and agriculture, cattle, et cetera. But what we've managed to do over the last several decades is we've got almost 1 million people living in Fort Worth now. And I don't think people realize that. All the growth dynamics that people love about Dallas, whether it's population growth, job growth, just overall economic dynamism, we've really diversified in Fort Worth to having an economy that's got numerous industries just like Dallas. All the growth metrics you see in Dallas, we have in Fort Worth, and we've actually outpaced Dallas in things like rent growth and job growth on a percentage basis for about the last 7 years. And that's something that if you ask kind of your mainstream investors across the board, most of them aren't aware of that today. I'll tell you, 13 years ago when I went in and we opened the Fort Worth office, virtually nobody knew that. But that was a dynamic that was already running. And I thought, you know what? If we can open an office here in Fort Worth and have the opportunity to kind of show the world what's going on here, I think it's something that we've been very fortunate to be a part of.
Right. So I think what also coupled with that, and I'm probably one of the largest apartment owners in Tarrant County, the county where Fort Worth's in, at least of the private kind of capital setup. What I realized a few years ago when you kind of the stories was the population growth and the job growth is on a similar rate, if not a little bit faster than Dallas side, but there really wasn't supply coming. And that all the supply that you see the headlines about Dallas Fort Worth leading the nation, that was all concentrated, on the Dallas side, particularly in the urban core, and then kind of the top flight suburbs like Frisco, McKinney, Plano.
Sure.
And then a few years ago, they started building some supply. So
Right.
we've seen quite a bit of supply, in particular in the kind of the downtown West 7th district, as well as the medical district is kind of where that is.
Right.
And to a lesser extent up into Alliance, so kind of to the north part of it. But it also seemed too that I was talking with a few years ago with some economists, and he was talking about the disbursement of the jobs. So the jobs on the Dallas side tended to be a little bit more white collar, maybe a little higher paying jobs, where on the Fort Worth side, we have a lot of industrial, logistics, there's a lot of military,
Right.
over on that part, Bell Helicopters, Lockheed Martin are based there. So the demographic of those jobs tend to be more blue collar, more renter based
Right.
people now that they don't do it. So it's really been driving the rent growth. And that's kind of what I've seen. Any observations around that, or any parts of these certain submarkets that you think have maybe a little bit brighter future than some of the other ones within the Fort Worth side of town?
Yeah, sure. No, I think you make a very good point about all the new product that's coming online. That's not a problem that Fort Worth has had for 35 years or longer. All the construction was on the Dallas side, and that was the opportunity, is you weren't really seeing a whole lot of new product going into Fort Worth. But what we have to remember about new construction, whether it's Fort Worth or Dallas, is it's a tale of two cities when it comes to multifamily right now. Your Class A product is going to be a little bit on the softer side because of all the new deliveries, and that includes Fort Worth. But when you get into the workforce housing space, I think there's some really interesting things about Fort Worth that people should follow. Number one, the Chisholm Trail Parkway is a complete and utter game changer for the city of Fort Worth. It connects downtown to kind of the southwest part of the city, which has always been an affluent, nice part of the city, but just hasn't been super accessible. You only had two streets running north and south, and it took you 20 minutes to get downtown. I commute from my home there now in 8 minutes to downtown Fort Worth. And so that's a real game changer. There's been a lot of real development that's taken place around there, a lot of real economic drivers that are occurring. When it comes to the workforce housing, anything near there, I love it. I don't, but I'm making a long-term bet. I think it's going to do for Southwest Fort Worth what the Dallas North Tollway did for Plano and Frisco and a lot of these other markets. It was a decades-long process, but I don't think you have to. I don't think you take a cyclical point of view. You look at it and say there are always going to be real estate cycles. There are always going to be business cycles, no matter what business you're in. There's no question cycle dynamics apply to Dallas-Fort Worth multifamily, but I think what you're seeing here is a generational, a secular type of a story. It's a generational story that we all get to be a part of, and so you make a bet like that around the Chisholm Trail Parkway, you're making a long-term bet in the real growth of the city. So there's good workforce housing opportunities there. West part of Fort Worth, you've had a lot of folks who, I don't like West Fort Worth, Las Vegas Trail. And of
Me
course,
included, right?
Yeah, that's right. But, I'm not saying go buy on Las Vegas Trail tomorrow, but there are opportunities on the west side of Fort Worth if you're looking, again, not to flip in a year or two, but you look at their building Walsh Ranch, just 10 minutes to the west of 820 and I-20 on the west side of Fort Worth. What's the closest pocket of workforce housing to what is going to be a 50,000 person city within the next 10, 15, 20 years out there? They're building rooftops and retail and office. There are going to be folks who are working there, but won't be able to afford to live there, and folks who are building all this stuff who won't be able to afford. So I think West Fort Worth is a good opportunity. Falls and Oak Village is a property we just closed a couple of weeks ago over there, 408 units in West Fort Worth. We sold that for $60,000 a door in 2017 to the current owner. And we sold it, we just closed at the end of December for $85,000 a door. In that short of a period of time, they went in there, they put money into it, they improved the resident profile. But there were people there who work at Amazon, who work at Facebook, who work at the Joint Reserve Naval Air Station. It's not like it was 5 years ago. And so you have to keep your eye on submarkets like that. The eastern side of Fort Worth, we did a deal over there called Havenwood that we sold in 2012 for, $33,000 a unit. It was a 7.5 cap deal. It was a record price per door. Nobody wanted to touch East Fort Worth at the time. We just sold it last year for $90,000 a door. Rents have gone up. Effective rents had gone up, $350, $400 per unit per month. And so people like to redline these particular submarkets and say, I just don't like it. But the same growth dynamics apply to those submarkets. It's a rising tide lifting all boats. And people, frankly, they get priced out of more B markets.
Sure.
And where do they go to live? And so you have to keep your eye on these markets as you're kind of reviewing investment opportunities.
Can we keep the value add story keep going and going and going? Because it seems like we're on, went from the original value add to the 2.0 and 3.0, and maybe we're on 4.0 now. Value add, just kind of keep value adding it. Do you still see the opportunity to continue to enhance the interiors, enhance the amenities of these 40, 50-year-old buildings and continue the rental rate growth?
Well, I mean, the short answer is I do see a continued opportunity for value add. Again, as long as the numbers make sense, there will always be opportunities to go in and make strategic improvements. I think part of the reason you saw such a frenzy on Fielder's Glen is because it was a rare, truly untouched value add opportunity. But the reality is the low-hanging fruit has mostly been picked over. The reality is that you're going to have to be smarter about how you're evaluating these properties. The good news is there's always innovations taking place.
Yeah.
And the rents have also moved up to a point where it justifies things in certain properties like granite countertops that you couldn't do before. Something big I'm seeing right now, a huge trend I'm seeing right now, is on the technology side.
Yep.
You're seeing things like providing Nest thermostats and Ring, doorbells and locks that you can operate remotely. I've heard of $100 rent premiums plus for providing a technology package, cable and internet, that's a big deal. Utility conservation, that hasn't been done still at a lot of these workforce housing properties. And so these are, there are innovations that are evolving. The rent structure has evolved to a point where maybe it justifies a different finish out, but it's about being smart about it. You don't want to overdo it or underdo it, but that opportunity is on the table. It's just going to take a little bit more work.
You observe a lot of people doing what you do that buy and operate multifamily properties. Have you noticed anything that that separates the more successful owners from the people that fail or are a little bit less successful? Any trait or two that you've observed?
Well, I've observed it first and foremost from your organization, SPI. It's been just amazing to watch you all grow over the years, and the story I told you earlier about upgrading your quality of location and product, you guys have executed that to a T. But what groups like yourself and the Madeiras and the S2s and the Western Wealths of the world, what separates the really successful organizations, the Nightvests, from kind of your standard owners? I think what they all have in common is the vertical integration and the scale. You look at the management companies, they are their own management companies. They're construction companies, they are their own construction companies. They have people in there who are dedicated to different parts of the business, and they're laser focused on it. And I think having the scale, number one, the diversification, and also the vertical integration, those are the keys, I think, to the most successful owners that I've seen over my career.
What if there is a risk in the marketplace? Not saying that you see too much risk, but if there's a risk, what do you perceive kind of going, now that we're in the first quarter of 2021, what's got you maybe losing a little bit of sleep at night, if anything?
Well, obviously you have macro concerns that are out there, but I think, as long as we are able to roll out the vaccine in an appropriate way, as long as we're able to kind of keep assistance in targeted strategic locations to people who really need it, I don't see us hitting some wall where everybody can't pay their rent and you have mass evictions. I don't think that's a real risk out there unless somebody really messes something up.
Yep.
And so outside of that, really, the biggest concern that our clients have are taxes and insurance.
Yep.
We've just been seeing these huge unsustainable increases in tax and insurance expense, and it's something you have to really be careful about how you underwrite.
Yep.
And so I would say really that's the biggest risk out there outside of things we can't control, or the taxes and insurance.
Is there anything that you hear that people perceive as a risk that you think is kind of unfounded, that they worry about and they shouldn't?
Yeah, I mean, my thought process is everybody's saying the market is too expensive or cap rates are too low. I can't pay that price per door. Look, that just traded a few years ago for so much less. Well, that world is no longer here. Okay.
Yeah.
And so you have to keep your eyes on the prize. You're probably not going to buy something today and flip it, in 2 years for $35,000 more a unit. Those types of opportunities are few and far between. But if you go out there and you do your homework, you have to look at it through the lens of that kind of secular growth cycle. It's not just a cycle that we're a part of. It's a generational growth story. And so I think worrying too much about the price per pound or the cap rate you're paying, I think that's a short-sighted concern. And I also think, that as we go forward, you're going to continue to see rent growth. You're going to continue to see job growth. All those long-term drivers, I think, in DFW are going to remain for some time. Another thing that's important to note is, yes, cap rates are low, but the 10-year Treasury is 95 basis points.
Yeah.
So the spread between the cap rate you're paying for something right now and the 10-year Treasury is actually wider than it's been at any time since 2012.
Yeah.
And that is a real metric to look at, because if you go back to 2007 when everything was overvalued, you could tell it was because there was virtually no spread between the 10-year Treasury and the cap rate you were paying for commercial real estate. Now that spread is actually wide by historical standards. So I think people need to consider the cap rate they're paying in the context of what interest rates are.
Sure. That's a good point, because the world's just awash with capital and is looking for a home,
right?
Whether it's in your money market account or treasury or workforce housing property in Fort Worth, Texas. It's looking for a return on its capital, and the spread being 400 basis points or whatever it is today. That's relatively wide compared to 07, 08 when everything kind of went to hell
right.
Shortly thereafter. So Al sells about as much workforce housing in Texas and Dallas Fort Worth as anybody. Al, if people want to get to know you, learn a little bit more about what you have going on, find out what your listings, what's the easiest way for people to get a hold of you?
Sure. Well, you can go to the website, which is www.silvamultifamily.com. You can call me directly, 817-932-6134. And we're located in downtown Fort Worth. So feel free to give us a call, send me an email, al.silva@marcusmillichap.com. On our website, you can sign up as a registered client and gain access to a lot of really valuable information. We also do a monthly market intel report that includes just a wide range of information. And we put this report together for all of our clients to see. So I highly recommend you sign up as a registered client on the website. And, we really look forward to working with you.
Yeah. So Al's one of the better brokers in town. We've done business together, I think 3 or 4 times. I sold a few properties for us, sold a property to us. One of my favorite properties he sold to us right now. We still own. Anyway, so I definitely recommend, if you guys are looking to come to Dallas Fort Worth, you're looking to get into workforce housing, certainly go check out Al's website, give him a call, reach out to him. He's a great guy. So for Al Silva, I'm Michael Becker. I appreciate it. We'll see you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.